Assalamualaikum and hi. My name is Nurul and Binti Saffe. My student ID is 2022-913-087. So today I will be presenting about capital structure. The study of capital structure aims to clarify how the state corporation combine various instruments to finance investment. The objective of this study is to be able to describe the financial distress, adjusted cost of equity, backing order theory, signaling hypothesis, and to evaluate the factors affecting capital structure and capital structure decision. So, what is capital structure? A company's capital structure can be defined as the mix of equity and debt used to finance both its growth and the company's overall operation. Equity capital comes from claims to a company's future cash flow and earnings as well as shares in the latter. Since it acts as the foundation of the company, the capital structure is the most crucial component of starting a company. The two primary sources of capital for a capital structure are equity and debt. So, how to determine optimal capital structure? The ideal combination of debt and equity financing for a company's capital structure maximizes market value while lowering cost of capital. Theoretically, because debt financing is tax deductible, it has the lowest cost of capital. However, if debt levels are too high, shareholders will face greater financial risk and will need a higher return of equity. Therefore, companies must determine the optimal point at which the marginal benefit of borrowing money balances out the marginal cost. There are 4 steps to determine the capital structure. Step 1 is to find a different capital structure with debt-equity ratio. Step 2 to find the cost of capital and cost of debt at different level of capital structure. Step 3, find the weighted average cost of capital, which is WACC. And the last step, which is step 4, is to reach an optimal level of capital structure through graph. The capital structure of a company is influenced by a number of factors, which also impact how the debt and equity components are distributed. This factor is divided into 2, which are internal factors and external factors. There are many factors under these 2 factors, but I will explain each 3 from both factors. The first internal factors that affect capital structure and capital structure decision is risk. The usage of debt increases financial risk because of the greater volatility in shareholders' returns and the possibility of insolvency. The next factor is financial leverage. A corporation will be able to deploy some debt with the goal of reducing the percentage of tax. This is made possible by having both debt and equity in the capital mix. And the last one for internal factor is cash flow. The ability of a company to generate cash flow expands the finance manager's option when choosing the capital structure. For the external factors, the first one is taxation policy. The choice of capital structure is directly influenced by high corporation tax rate, as well as high dividend and capital gains taxes. The second one is level of business activity, in which when a company's level of commercial activity rises, more money is needed for expansion and diversification. And the last one is level of interest rate. A company might delay the mobilization of funds or utilize retained earnings if the banker or financial institution expect to get a higher percentage of interest. Next, I will move to the financial distress. The phrase financial distress is frequently used in the context of corporate finance to refer to any circumstance in which a person or organization finds it difficult to meet their financial obligation, particularly loan payment to creditors. A company must identify warning indicators early and take the appropriate precaution to avoid entering a time of financial distress. Otherwise, it gets really challenging to come up with solutions. Financial distress that is severe and persistent might eventually result in bankruptcy. There are a number of warning indicators that might show a business is in financial distress now or soon will be. The first one is, if there is a persistent shortage of money, that is the first indication that something is lacking. Next, if the company's product or services may not be in demand based on its current business strategy, if revenues are declining or growing slowly. And the last one is when debtors take an excessively long period to pay their debts to the business. Even if it may seem challenging, there are certain solutions to make things better and deal with financial distress. Reviewing company plans is frequently one of the first steps taken by companies. Besides, the company can cut expenditure to deal with the financial distress. Furthermore, some companies could think about reorganizing their debt by renegotiate the term of their repayment in order to increase their liquidity. Distress cost is the term used to describe a cost that incurred by a company in addition to the cost of doing business, such as a higher cost of capital. Companies that are struggling often have a harder difficulty paying their debts, which increases the possibility that they may default. In order to pay immediate obligation, it could be necessary to sell assets quickly and at loss. Distress cost divided by two categories, which are ex ante and post ante. Ex ante means before the event. It refers to the predicting of an event before it occurs, and the conclusion is undetermined. The obtained ex ante value may then be compared to the actual performance when it occurs by making the result prediction. Post ante means after the event. Investment firms employ this idea to predict a security's anticipated returns based on the security's actual or previous returns. Ex post is a representation of the company's real outcomes, which are the investors' returns. This graph demonstrates how the present value of tax shield on debt rises in response to an increase in the present value of the cost of financial distress. Thus, it is clear how both are incorporated into one another. The value of the anticipated tax shield from debt rises as the debt level does. However, the value was lost because of the anticipated expense of financial distress. At some point, the marginal benefit from interest tax shield is just offset by the marginal cost of more expected financial distress costs. As a result, the optimal level of debt in the company's capital structure is limited. The conflict of interest that arises between management and shareholders is referred to as agency cost of equity. And agency cost of equity arises when management takes action that shareholders see as not being in the company's best interest and as not increasing the value of their shares. For instance, management can think that a merger would be the greatest move for the company, while shareholders would recognize that the merger would not help the company develop and that the money spent on the merger might be better utilized to pay dividend and invest in other areas. The agency cost of equity would be those incurred as an effort to stop the merger, such as lobbying expenses. The pecking order theory refers to managers access funding sources in an order of hierarchy. Managers choose the following sources to finance investment opportunities. First, retained earnings of the firm, then debt, and as the last choice, equity financing. The idea of asymmetric information leads to the pecking order theory. When one party has more knowledge than another, this is referred to as asymmetric information and it leads to an imbalance in the transaction power. In simple terms, external sources of funding expect a greater rate of return to make up for higher risk because of information asymmetry. Internal finance is the least expensive and most practical method of funding compared to external financings like debt or equity financings, where the firm must pay fees to receive external financing. Managers favor debt over equity when it comes to external funding since debt has a lower cost than equity. The issuing of equity conveys a warning that the stock is overpriced and that the management is trying to raise money via dilution of company shares. Information gaps between shareholders and company management give rise to the signaling theory. Managers will initially issue loans and only issue stock as a last option if they think their companies are undervalued. The signaling hypothesis was initially proposed by Rose, who claims that if manager knows inside information, their choice of capital structure will convey the information to the market. According to Barclay, Smith and Watts, undervalued businesses are those whose earnings rose the next year, whereas overvalued firms are those whose earnings fell. They discovered a very weak statistically significant correlation between leverage and unexpected profits. So that's all from me about the capital structure. Thank you for listening.